HiCount LoCount is another relatively simplistic study and is a derivative of peak. The main parts in the New Methods of Technical Analysis book that you would refer to is pages 190 and 214 for some ideas of how they can be connected together. Here I'm just going to go into two basic setups. First of all, what is HiCount LoCount? All it does is it counts the number of bars between the changes of the low peak value, which is the blue line, and the red line, which is the high peak value, and creates those two sort of steps, as it were, underneath the market. The philosophy behind this is really to do with how far a market can trend before some sort of corrective phase at least is due, and tests over thousands of different systems really over a very long period of time showed a fairly consistent pattern that quite often that some parts of a trend can really only extend normally for between 15 and 20 bars without some corrective phase actually appearing. The difficult bit is to then know whether once that corrective phase occurs whether the trend is going to restart. That's for another video, but for this one what we have here is a horizontal line on the HiCount LoCount study which is set at 15, so that's the magic number, and we're interested once either value goes beyond 15 and then corrects back to 0. In truth, it can on occasion go significantly above that, but it's pretty rare, but you're waiting for it to reset anyway and go back to 0. The other key interpretation of HiCount LoCount is actually when we go above 15 and reset, where we actually are in the trend. And what I've got here is I'm using an example which is CNC, which is a healthcare darling, and the first triangle, or the first rectangle, sorry, is marking a power play signal, which is a green bar. Classic power play, making new highs, expansion of range, signals that an uptrend is ready to restart after a period of sideways. This subsequently occurs, and the key moment is when the HiCount LoCount goes above 15 and we have this acceleration phase in this area here. Now it's obvious that the trend has already been going on a considerable amount of time, and so if you were to get an acceleration by no changes in the HiCount LoCount, so in other words no sellers can push the market down and create a corrective phase, or there's no relatively small amounts of activity that can make the low peak move as well. So once that goes to 15, resets to 0, it's telling us two things. This is either the end of the trend, or is the high of the move, or there is one more high to come in the current trend cycle. So that's really, really important. What happens is we do get quite a sharp correction, and the peak changes and the HiCount LoCount resets. We do actually close below a peak, which for the very nervous or the risk averse, then that would be an exit in itself. As it turns out, the market does just make one more new high, and the reason for that philosophy is normally when you get an acceleration phase, there's people who are coming late to the party, and so when they get that dip back down they think, oh, here's my opportunity, I can get long again, and so it just makes another high, and then we're looking for a reversal. And it followed the script. We could see that little pink diamond, and what that is a time continuation divergence signal. It's got the reversal switched on and the expansion of range, and that, if you hadn't got out on the peak breaking or the HiCount LoCount resetting, that was a very strong indication to say it's time to leave this party, take your profits and go and look elsewhere. If you're very aggressive, there is an opportunity to get short there because it's very obvious and easy to know where you put your stop in. And the scale a little bit betrays how much that correction phase is. That stock dropped from about $71 down into the low 60s and did it only in a couple of days before stabilizing. The peak then moves down, and that could say, okay, now we've found some support. So if you're being more of a short-term trader, that would be enough to say, well, if I was short, I'll take my quick 10-12% and go and look for something else again. Of course, if we're referencing the daily data and we know that we're coming to the end of a trend and we think we can take advantage of that, we can go fishing and can go looking for other signals where we're going to get better returns. And so I've taken the same chart, CNC, but this time it's on 120 minute. And what happens when it goes to those new highs that fulfills the criteria of the trend ending, the HiCount LoCount in both instances goes to 15, and we get a time continuation signal with an expansion of range on the 120 minute as well. So we can go into lower time frames from referencing higher time frames. Stop.